Hey folks, welcome back to my channel, safdt. So, you have worked hard for your money. You decided to spend your money because you think you deserve it. And you deserve your hard-earned money because you work hard for it, right? However, do you plan to work forever for it? Some people would start to think how to not work forever, how to work for fun and not for money, and how to have money that can sustain you while you are growing old. Investing is the best next move to do this, and I believe you can Google anything and there will be plenty of information out there to justify why or how so. Otherwise, I can create a whole new video about this next time. No matter what, you can't deny that investing might be necessary to reach your ultimate financial goals. Now, this might not be a financial advice, but it's worth to consider. I mean, you have worked hard for your money, so it's important that you have a solid financial plan that will help protect your wealth as well as growing it. Investing would be a part of that plan, and a smart, proper strategy would help in a lot of ways. However, investing is often misunderstood. There is no doubt that there are misconceptions about this idea of investing. Some can view it as impossible thing, while others equate it to gambling. And these misconceptions about investing can slow you down. I mean, misconceptions can literally deter many from promising financial opportunities and what they can achieve. And I've seen with my own eyes as well as heard from enough people to conclude. So again, would you rather have $100 today or $125 in 1 year? Most people would prefer $100 today because you can just use it immediately, and $25 seems like a small amount as compared to $100, and hence waiting for a year might not be worth it. However, that is actually a 25% annual rate of return, which is actually a lot. Unfortunately, a lot of people these days still behave this way. So, without further ado, let's debunk 4 common investment myths in this video. Number 1. I need a lot of money to invest, aka I have to be rich. This, to be frank, might have been true in the past, but these days it no longer applies. There's more and more wide variety of online platforms and online investment advice services available out there. Furthermore, there are these things called robo-advisors where human capabilities and algorithms are mixed together. Even for the platforms available, they all have competitive prices. What about the investment advice services? There are a lot more companies these days doing this too, that the premiums are very competitive. So, you guys probably have already known where I'm going with this. You basically don't have any excuses to not start unless you don't have even the slightest amount of money. Then that's a different story. You need to get your finance right first then. So basically, due to the competitions in this field, you can pretty much start investing with relatively less. But honestly speaking, the most common issues for not investing that I saw are either procrastination or overthinking. Be honest to yourself and ask yourself whether this is true. Anyway, there is still a legit reason as to why not starting investing, which is how to start. Well, one of the simplest ways to start is with unit trust or ETF, which stands for exchange traded fund. ETF is an easier way to start because you can pretty much buy these yourself. Meanwhile, for unit trusts, platforms these days are amazing enough to let you access them too. But the problem comes when you don't know what UT to buy or invest in, since there are a lot of varieties with different purposes. Financial consultants usually will come in handy in this case. Furthermore, investing in unit trusts or ETFs usually support diversifications, be it across different asset classes or geographies, depending on the fund's investment strategy. That means your risk in investment is reduced. So, investing is definitely not just for cashed out CEOs or Ferrari driving stockbrokers. But you do need a capital to start with. That's how you earn money with money after all, like more money with money. The difference is you can start with a small capital. Maybe even investing isn't just for the rich after all. However, you have to be realistic too. It definitely can be helpful to have more capital, as bigger investments can potentially lead to higher returns. But again, it is in no way a necessity. Therefore, you have to know your time horizon and have your finance planned out first. This is very important. Bear in mind that starting first, no matter how small, is better than not starting at all. So yes, thanks to competition and the advancement of technology, the cost has been driven way down. What you should worry is no longer how much you can do, but more of how you can start. Now, myth number 2. It's too risky, it's like gambling. Now, I'm not gonna lie, there are definitely risks involved in investing. Any trustworthy source for investment opportunities will always include a warning like, you may not get paid what you invest, or it is not a guaranteed return. It is a fact. Perhaps you also have heard stories about people losing their money in failed investments. Then, why are the richer people in the Wall Streets or the CEOs all do investments? I mean, they don't just do stock investments. Their investments are probably way more diversified in a lot more different asset classes. Let me pause here. I'll give you time to answer. Never mind. It's pretty obvious. There must be a reason why a lot of people are still doing investment in this world, right? So yes, it is yet another very misleading assumption that investing works the same way gambling does, assuming that it's all about luck and speculation when it is not. I mean, just like in everything in life, luck probably plays a role, but it's certainly not the driving force behind successful investments. In fact, it actually involves thorough research, analysis, and making informed decisions based on facts and data. Successful investors develop strategies, diversify their portfolios, and manage risks effectively. All of which to minimize the fear of risk or the risks themselves. So the key is to understand the risks involved and how they can change over time. That way you can make an educated decision about how much risk is right for you. And by taking a calculated amount of investment risk, you can give your money greater potential to grow than letting it sit in your savings accounts. It is all about risk management. You can find some lower risk investments, such as what's known as a cautious fund. While there is still risk, its value isn't typically expected to fluctuate much. Therefore, this means you could invest and enjoy a much smoother, gentler ride over time. Now, if you are really not sure, please do reach out to reliable and financial advisors who can help you plan your portfolio together based on your financial goals and risk appetite. They should also be able to help to diversify your portfolio, spreading your investments across a range of aggressive, high risk and conservative, low risk asset classes. Now then, if that sounds alright to you, why then investing still has such bad stigma? Investors react much more strongly to losses than to gains. The fear that putting money into the stock market could lead to financial greed keeps many people out of the market that may keep them from reaching their goals. I believe you also have such fear when thinking about starting investment, right? But again, the good news is there are things you can do to help manage the amount of risk when investing. For instance, some types of risk can be mitigated with diversification. If all of your money was in one stock and the company went out of business, you would have lost your entire investment. But if you own many different stocks, one company likely represents only a small portion of your portfolio. Similarly, adding different types of investments like bonds and short-term investments can also reduce the amount of risk in your mix. When it comes to investments, stock picking is not necessary or even encouraged. Trust me. Investing through mutual funds or exchange-traded funds or ETFs lets you invest in many companies at once. Getting professional management and diversification, keep in mind that diversification and asset allocation do not ensure a profit or guarantee against loss. That's why it's important to build a mix of investments that you can live with the potential to hit your goals. The amount of time you plan to allow your investments to stay in the market makes a difference too. With a very long time in the market, history suggests that your chance of permanently losing money in a diversified mix of investments goes down. That's because stocks have tended to rise over time, and as long as you don't sell your investments, they may recover from market downturns. Here's the chart of the S&P 500 index by Fidelity Investments from the very beginning of the time until this year. But do take note that past performance is no guarantee of future results. Now, myth number 3. I'm too young to start investing. Yeah, this is a legit reason that some ambitious kids actually face. However, if you are one of them, ask your parents for help. I do know some underage students who started young just because the parents want them to show the results when they grow up. However, it is unacceptable if you are already a working adult to use this reasoning. I mean, come on, 24 years old or 25 years old is not too young to start investing. Moreover, you actually probably have started working. In fact, most of you around this age would be planning to get married already, most likely, which is a bigger commitment than this. Stop giving excuses to yourself. If the reason of you thinking so because of the inability to look far into the future, just do it. Time is of great advantage to you when you are young, and long-term investment strategies tend to be less volatile, which may help to build your wealth through compounding interest. Trust the process and act accordingly. Just think about your future self. Myth number 4. You can time the market, or you buy only when the time is right. Time is right. Alright. Oh boy. This is a classic. Let me tell you one thing. Everyone knows that in the market you should buy low and sell high, right? I believe you will agree with this too. However, most often than never, people end up buying high and selling low. Why? There are so many factors influencing the stock market that predicting when a share price will bottom out or hit its peak is practically impossible. But there's another saying about investing. It is not about timing the market. It is about time in the market. The main point of it is basically it's impossible to know what the future will bring. Timing in the market means buying an asset with the expectation of selling at a high price at the right time. Meaning, selling when you think it might have reached the top. Usually this is akin to trying to beat the market by outsmarting it. After all, just buy when the price is cheap and sell when you think it's overpriced, right? But no, it is simply impossible to time, just like how nobody guessed COVID was coming in 2020. Time in the market usually means relying on a dollar cost averaging or DCA strategy, where you don't try to guess when the market is at its lowest or highest point. Instead, you just invest consistently regardless, which eventually the fundamentals matter more than timing. Usually people would mean to choose quality investments, remain patient even during market volatility, avoid short-term speculations, and your investment should do well in the future. But again, in reality, it's not always that simple. Hence, you still have to do your own research. Also, but again, rather than waiting for the best time to invest or start investing, it can often be a better idea to just get invested. Waiting for the best time can lead to a lot of missed opportunities. Now, studies have found that most of the time, investing a lump sum results in higher returns. But if you need to ease into the market, other research has found that dollar cost averaging may mitigate some risk. It is important to understand though that periodic investment plans like dollar cost averaging do not guarantee a profit or protect against loss in declining market. And investing a lump sum doesn't always result in higher returns, as it depends. At the end of the day, whatever helps you get invested and stay invested may be the best strategy for you. That's because missing just a few days or a few best days in the market can have significant impact on long-term returns. Here's a graph illustrating how missing the best days can affect your long-term returns. Alright, so that's all folks for today's debunking myths. If you have any constructive ideas, please leave them in the comment section below so we all can learn together. And if you do enjoy the video, please leave a like and subscribe to my channel so you don't miss anything. Thanks for listening, folks. Until the next video of Debunking Myths. Peace.